Welcome to another webinar with Mariner. Today's session is on Roth accounts, Roth IRAs, Roth 401ks. In an ever-changing tax landscape, understanding the nuances of Roths can give you a leg up in strategic planning for a prosperous retirement. Roths are one of the coolest products in the wealth management world these days. However, they are complicated, which means that there's a lot of confusion around them. So today's goal is to demystify Roths for you and also get you excited about how Roths are being used in your financial plan or could be explored. You're right. I'm going to stop sharing so you guys can see our panelists a little bit better. All right, so we do want to make sure that this session is engaging for you. And so we'd like to hear from you. Please use the Q&A feature at the bottom of the screen to submit your questions. We will try to answer them live if possible. If not, we'll get to them at the end. Closed captioning is enabled for this webinar. If you'd like to use it, please click on the CC icon at the bottom of your screen. Allow me to introduce myself. My name is Christina Lynn. I am a member of the practice management team at Mariner. I am joined today by three amazing tax experts that we have here at Mariner. We have Kirsten Wiles, a certified financial planner and enrolled agent. She's a wealth advisor here at Mariner. We have Ellen Pfeiffer, a certified public accountant, CPA, a director in our tax team at Mariner. And we have Jody Robinson, also a CPA. She's the vice president of tax services at Mariner. They are going to help answer many of the common questions around Roths, questions that you've never thought of asking about Roths, and we'll do some myth busting around Roths as well. So before we dive into the nitty-gritty of Roths, let's get to know our panelists a little bit better. So ladies, please share with us one financial habit, a financial tool, a financial resource that you swear by in your own personal financial planning or investment strategy.
So I'll go ahead and go first. I always tell people start early and remain consistent. If you start investing in your company-sponsored retirement plan or your own IRA as soon as you can, then you're doing yourself a huge favor. This is timely. My son, who's 15, just got his first paycheck this morning. And after having the disappointing discussion about Social Security and Medicare tax, we took a percentage of his gross pay and moved it to a Roth IRA for him. So I'm getting him started in the habit of that's just something you do every time you get paid.
I love it.
Great one. I'm a numbers person. So for me, it's Quicken. I use it to track all my expenses. I have my portfolio integrated in there. Everything is kind of at my fingertips, and it just allows for, to me, a little bit better planning.
Like Ellen, I am a numbers person, except I'm even more old school than that. I'm diligent with good old-fashioned organized filing with all of my personal documents, making sure that there are organized folders for tax, for estate, for legal, for insurance, all of those different types of things so that it's easy for someone to come in and find if needed. And then to help keep myself on track, I rely on good old Excel spreadsheets for budget and tracking. So nothing too flashy here, but still record keeping is important.
Those are gems. Thank you, ladies. All right, so Jody, let's start with you. Please share some basic information about Roth accounts.
Sure. So Roth is a type of retirement account that you're going to contribute to with after-tax dollars. And what that means is that you are bypassing the tax deduction on the front end when you make that contribution. But the benefit is that it's going to grow tax-free from there. With a traditional IRA, you're going to get tax deferred growth, but a Roth offers you the tax free growth. Couple other requirements in order to be able to make a Roth contribution. You have to have earned income or a spouse who has earned income. You also have to be below earnings thresholds or modified adjusted gross income thresholds in order to make a direct Roth IRA contribution. For 2024, those amounts are $161,000 for a single person and then $240,000 for married filing joint. So as long as you're below those thresholds, you can make all or a portion of a Roth IRA contribution. Contribution limits for 2024, $7,000, unless you are age 50 or over, and that's $8,000 that you can make as far as a contribution. And then this is timely as we approach the April 15th deadline. You are eligible to make a Roth IRA or any IRA contribution up until the tax filing date of the following year. So for before April 15th of 2024, you can still make a 2023 IRA or Roth IRA contribution. So that's something to keep in mind. If you haven't already done so, check to see if you're eligible and then go ahead and make one.
Perfect. Jody, that actually did answer part of Tom's question. We'll get to your other question, part of your question, Tom, a little bit later. All right. So staying with Jody, tell us the considerations for contributing to a Roth IRA versus a traditional IRA.
Right. So just a few things. We're always encouraging our clients to start making any IRA contribution as soon as you're eligible to, but even more so with a Roth IRA because of the power of the tax-free growth that you're going to get. The sooner that you can make those contributions, the more growth you're going to have over the years and the decades that follow. In addition to that, a lot of people want to consider whether they want the tax deduction or not. So some people falling under certain income thresholds may be able to make a deductible traditional IRA contribution. So that's something that you have to evaluate is, do I want the current tax deduction or do I want to forego that tax deduction to get the tax-free earnings of a Roth? So I'm always in favor of making a Roth if you can, but for some people, prioritizing a current year tax deduction may outweigh that. A couple of other things in comparing Roth to a traditional would be the availability or eligibility to take distributions. So normally when you make a traditional IRA contribution, you've essentially locked in that money because if you take it back out, it's going to be a portion of it's going to be taxable to you. And if you take it back out before age 59 and a half, you're going to be subject to a 10% early withdrawal penalty. So that's a traditional. A Roth, once you make that contribution, you could at any point pull that contribution back out tax-free. So if I contributed 5, needed an emergency, had an emergency at home, I'm not encouraging people to take money out of their retirement account, but if you needed to, you could take that $5,000 right back out tax-free. Now, in order to take earnings out tax-free, you would have to have it in the account for 5 years from the date you make that original contribution, that very first contribution, the 5-year clock starts ticking, and be age 59 and a half. So you just have to meet certain requirements in order to take earnings out, penalty and tax-free. And then lastly, and I think this is almost most important, is that there is no RMD required minimum distribution requirement on a Roth. There is on a traditional at age 73 now. Once you turn 73, you need to take RMDs from your traditional IRA. There is no RMD requirement for a Roth. So as long as you don't need that money, it can stay in there and continue to grow tax-free.
Perfect. Great information, Jody. Shearson, let's transition over to you to talk about high income earners. So what are your ideas for income earners to get dollars into a Roth account if they're above that income threshold that Jody mentioned?
And so you think, okay, I'm over the income limit. There's nothing I can do. Wrong. So there are ways you can put money into a Roth, even if you're over the income limit. The first way is if your employer-sponsored retirement plan, whether it's a 401k or a 403b, offers a Roth option, you can put money in that Roth without worrying about the income limit. There is no income limit. Any employee can put in either one. You can split the contributions. You just can't go over the amount of the contribution between the two. The second way to do it is what's called a backdoor Roth contribution. So it's in essence taking money from your bank account and moving it to a Roth IRA by way of a conversion. It's just a longer way to get there. So you make a contribution to your IRA, say of $7,000. You're over the income limit to deduct it, so you're not able to deduct it, but you immediately convert it to a Roth IRA. That conversion is not taxable because you never got the deduction on the contribution. There's a gotcha with this one, though, because the IRS has what's called the pro-rata rule, where if you have outstanding IRAs, so whether you have a traditional or rollover IRA, the portion that is not taxable upon converting is proportional to how much you have outstanding in IRAs. So if you have a $7,000 contribution you've made that you weren't able to deduct, but you have $70,000 in IRAs sitting out there, only 10% of what you convert is going to be tax-free. The other 90% is going to be taxable. So this is where we say, don't try this at home. You really should talk with a professional to make sure that you're following all the rules, that you qualify for it, and you report it correctly. Otherwise, you're going to end up with unintended tax consequences. And then the third one is called a mega backdoor Roth. And this is done within your company-sponsored 401k or 403b. So beyond the regular limit that you can contribute, some plans will also allow after-tax or post-tax contributions to that plan once you've hit that first limit. So that second limit is limited to the IRS limit for a plan for a year, which this year is $69,000. So say you're 50 and you contribute your $30,500, you still have $38,500 that you can do after tax. And that assumes your company doesn't match anything because that would go against that limit. But you could put in $38,500 post-tax. And the idea is that within the plan, they convert that money to Roth. So it's another way to get the money in the Roth. There are a lot of things you need to understand about the plan itself, how often they convert, whether they even allow the after-tax contributions, how often they convert, whether you have to ask them to, whether they do it automatically. But that is an option to consider as well.
Lots of great options for high income earners,
Yes.
or at least a couple of good ones. Okay, so Shearson, a popular comment we're getting questions on is about Roth conversions. So when it comes to putting together a financial plan, can you tell us what a Roth conversion is and how it might be used as a strategy?
Yeah, I saw in one of the questions, someone called it Rothifying their IRA, and I like that term. But it's basically taking money from your traditional or rollover IRA and converting it to a Roth. At the time when you convert it, the amount you convert becomes ordinary income on your tax return. So you're agreeing to pay the tax now, but then you're turning it into a tax-free asset. So there are a whole lot of considerations that have to go into this, and they intertwine with a lot of other decision points. So it's something that the answer of whether or not you should and how much you should will vary person to person, and even for the same person year to year. So it's something we continually look at. But one of the considerations we look at is, do you have the cash outside of the IRAs to pay for the tax created by the conversion? You don't have to have the money outside, but if you pay for the tax on the conversion with the conversion money, it really mutes the impact of the Roth. So if you convert 10,000, but you take 3,000 of that to pay the tax, having 7,000 in that Roth IRA is less powerful than being able to put all 10 in. Another thing we look at is how much you have in total qualified assets, because maybe a reason you want to convert is to reduce your RMDs in the future. If you have a ton of retirement assets that are all pre-tax, once you hit 73, you're going to have to take quite a bit out. That's going to bump you up into higher tax brackets. If you convert some now, then maybe that's going to reduce the tax bracket you're going to be in later. The last consideration that I'll talk about is whether or not you have human beneficiaries. So if all of your beneficiaries on your retirement accounts are charities, they're never going to pay tax on the money, so there's no reason to leave them a tax-free asset. So those are just some of the considerations.
Okay, so Sherston, you had said that if, or maybe Jody said this, but we still have up until the tax filing deadline in order to make a contribution to a Roth IRA for 2023. Does that also apply for Roth conversions? Can I make one now for 2023?
That's a great question. So no, Roth conversions are done within the tax year. So if you decide to convert on December 2nd of 2023, that's a 2023 conversion taxed in 23. Anything you do in 24 will be for 24. And there is no maximum that you can convert in any given year. You can, as that person's question said, you can Rothify as much as you want in any given year. There used to be a rule that you could undo basically your Roth conversion. And a lot of people were doing that depending on what happened with the market or if their tax situation changed. That's no longer available. Once you convert, it's a done deal.
Yeah. That's an important note. There are no redos.
Perfect. There's a lot of really great questions. Let's get to some of the basics. I think that a lot of these things will be answered with what we have lined up for questions, at least the next couple ones. Ellen, there's a lot of mistakes around Roth contributions and Roth conversions. Can you highlight some of the main ones that you see?
I think some of the main ones are pretty basic and what we just covered. So number one, know that you need earned income, know their income limits that limit your ability to make these contributions. Like Sherston explained, if you have outside IRA money, there's the pro-rata rule, and that backdoor Roth contribution that you thought was going to be completely income tax-free turns out to actually be significantly taxable. I'm usually the person who gets to break that bad news to clients. And then tell your accountant what you've done. I've seen a lot of returns prepared by others where the Roth conversion actually turns into a taxable distribution from your IRA account. So communication and working with your advisors and things like this is just so important.
Perfect. So, Ellen, let's stick with you for another question. We are learning about how powerful Roth conversions can be. What are planning considerations when doing Roth conversions?
Sounds great. What we're trying to do is we're working with our clients and talking to them about their future. We're looking at the whole picture. Are you planning on staying in your current state? Are you looking to move to a state that has no income tax or has a reduced income tax rate? That may impact your timing for for doing one of these conversions. We also want to know what your plans are to leave your IRA assets to your beneficiaries. Are your children high income earners? If they are, then really an estate play may be to pay tax on these IRA funds at conversion at your marginal rate when it's much lower. It's really important to understand what the bottom line impact of a conversion is, which often is more than just income tax. When you are paying Medicare premiums, the higher your income is, the higher your Medicare premiums are. And we try to be cognizant of what we're doing when we're actually recommending these conversions. So for our planning purposes, it's looking at what your income is year to date, what we think it's going to be for the rest of the year, and then what taxes will be due on those conversions and what have we done to your Medicare premiums for the future. And then we talk to our clients about it to make sure that they're comfortable with the process.
Yeah, lots of planning involved, lots of calculations, projections. Okay. Sherston, another important Roth topic is planning how you might leave an inheritance to loved ones or charity. Talk to us about legacy planning with Roth accounts.
Right. So there are a couple of different ways to look at this. For someone who has a taxable estate, it's actually a really great plan to convert and to pay the income tax on the conversion, because that income tax is going to reduce your taxable estate. Not to mention the fact that you have now then just left these heirs a tax-free asset, which is fantastic. Another thing is when we're talking about, say, gifting as part of a legacy plan, something what you want to do for your kids, grandkids, a great thing to do is to start contributing on their behalf to their Roth IRAs. In a lot of cases, I see where parents will match what their kids put in their accounts. If you're very generous, maybe you do a $2 for the parent for every one the kid puts in. But either way, it gives them an incentive to do it. It gives them some knowledge about, especially if you give them the power to learn about how to invest it and what they want to invest in. You might end up with a portfolio like my 18-year-old daughter who owns Lululemon and Starbucks and Amazon, but she's at least learning what, it is to invest and, what it means. But, the knowledge of passing on what you've learned to the kids in a way that's meaningful and will help their future. So.
Perfect. I've learned that strategy about matching contributions for your kids into the Roths. I'm gonna adopt that one. Okay, Jody, let's talk about red tape. I know this is a favorite topic of yours. So there's a lot of red tape regarding the Secure Act and inherited IRAs. What should we know about that?
Right. So Secure Act had significant changes for beneficiaries of inherited IRAs. It limited the option to stretch IRAs, inherited IRAs, over most beneficiaries' lifetimes, limited that, and for most beneficiaries actually put a time cap on when that IRA had to be fully distributed. So those were some of the big changes of Secure Act, but specifically focusing on Roths. With Roth IRAs, the original owner of the IRA is deemed to have died before their actual required beginning date to take RMDs, required minimum distributions. So for most beneficiaries, in that case, most beneficiaries of a Roth, there is no RMD requirement. Now, the nuances to that, and staying at pretty high level, because we could spend a lot of time going down a rabbit hole that we just don't have time for. Spousal and other limited special beneficiaries can still elect the stretch option to take that Roth IRA in annual distributions over the rest of their life. So they still have that option. Most other beneficiaries, like adult children or any other type of beneficiary, are going to have 10 years to empty out the Roth with no RMD requirement. So most people, if you inherit a Roth and you fall in that I'm not a special beneficiary category, you're going to want to most likely just unless you need that money, let that ride in the Roth IRA account and grow tax-free for as long as you possibly can, and then take it out at the end of the 10th year.
Okay, perfect. Thanks, Jody.
Mhm.
All right, Ellen, what other tips or strategies do you want to reinforce here?
I think, like Kirsten said before, when your children start making earned income, that making gifts to them, contributing to Roths on their behalf is a fantastic way to really kind of set them up for life. We also look for dips in the market for conversions. Obviously, there's no way of really making sure that you've got the bottom, but we did have a client in March of 2020 who had an IRA valued at $1 million, which had fallen to $600,000, converted it to a Roth, paid the tax on only $600,000, and obviously it rebounded and then some. And another one, if you could just put up that slide for me, this is my favorite one when we're out talking with clients. What we try to do is manage your tax brackets. There's years between retirement and when you're required to take your RMDs that you normally are in a much lower income tax bracket. And you can see here, we're looking to fill in those years where you have no income. And those are the ones in this slide that don't show the blue vertical bars. So we do quite a bit of planning between retirement and RMD age to see if we can just, convert and pay maybe no tax or pay very, very little.
Okay, perfect. Now, Ellen, I know you had mentioned right away answering this question that you can contribute to your kids' Roth IRA accounts as long as they're earning income. We've had a number of questions about contributing to grandchildren's Roth IRAs. Can you just touch on that quick?
You can do that as well. You can contribute. Really, it's the same thing for gifting. You could make these contributions to anyone's accounts. It's just going to be considered a taxable gift. And as long as you're under the annual limits, which for funding a Roth you would be, it's not a reportable event. So yes, you can definitely make those contributions.
But the grandchild has to earn income.
Yes. So sorry. Yes. Earned income is important, and you're limited to the amount of the earned income. So say you only have $1,500 of earned income, you can only make a Roth contribution for $1,500.
Gotcha.
Great point.
I have a lot of clients that, kind of clamor to have their children's tax returns completed because they're dying to make their Roth contributions. And sometimes we have trouble getting the W-2s from the kids and things like that. So we always have our kind of little fire drills between now and April 15th trying to get the Roth contributions funded.
Yeah, it's powerful to get those started for kids when they're young. Okay, Kirsten, back to you. As a advisor, you have a unique perspective on Roth tax planning. Can you share any success stories that you have around that?
Yeah. So, I mean, I have to say, there are a lot of scenarios that fall into what Ellen showed us on that slide that we really can take advantage of some of those low years. But the one story that will always stick in my head is we had a prospect come in and they shared their tax return with us. And in looking through it, we noticed that they had negative taxable income for the prior year. And it was a unique situation. They were living off of their investment assets. They had retired young, so they didn't have Social Security. They weren't taking IRA distributions. And because they had negative taxable income, they could have converted for free. And that's not something we typically see, but that is why we won the client. But those are situations that we try to look out for. If a situation with a client changes and we see that we have an opportunity to do something in a unique situation in any given year, we're looking for that.
Yeah. What I'm hearing is that, yes, there's a lot of commonalities that you see in tax planning, but every case is unique. So it's hard to give like black and white advice here.
Exactly.
Yeah. Okay.
I had a client that had already used their entire lifetime gifting exclusions, completely maxed out. And she had $4 million in an IRA and one young son who was a beneficiary. And we rolled the entire IRA over, paid the tax on it. She then basically had converted this asset to a completely tax-free asset for her son to retire. And the income tax on it didn't count as a gift. It helped further reduce her estate, just like Schertzman was talking about. And something like that is super powerful as well, but everybody's different.
Right. Okay, so let's take some questions from the audience now. There's a lot of really great ones. So a number of them are focused around kids and contributing to their Roth IRAs or leaving it to them. Can you walk us through just the logistics of how exactly you open up a Roth IRA for a child and how you contribute to it for them?
Well, I'll take this one just because I recently did it, but it's very common for the major custodians to have a whole section on their website about accounts geared towards children. And one of those is a Roth IRA. And so it was pretty simple to set up. In my case, I attached that Roth IRA to a checking account that he had set up. And that's the same one where his check is deposited every other week. And so I just go online and ask it to make the contribution from his checking account to that account. But the whole process was quite simple. And if you're looking at how you can help contribute as well, you can either put the money in his checking account or connect your account to that Roth IRA as well. But it's very easy to do. And again, most custodians understand that that's something that's very, it's not just about the custodial accounts now, that Roth IRAs for minors is becoming very popular.
Okay.
So when you're setting up the account, Kirsten, you're setting that up as a custodial IRA in the name of the child.
Right. So they call it just a Roth IRA for minor.
Right.
So I'm on it as well. But yes.
Okay, and let's flush this out just one step further. When the child turns 18, what happens?
So 18 or 21, depending on the state, that would become it would no longer be under the custodian's power. So it become their money, much like a custodial account would, where technically they could do what they want with it, but you hope that whole starting early and instilling the power of the longevity of the Roth IRA stays with them.
Okay. There's a number of really great kind of technical questions, and I realize that you can't get too into the weeds because it really depends on the situation, but indulge me here. You can tell me no thank you if you can't answer it, but we've talked about Roth IRAs, we've talked about Roth 401ks, we haven't talked about 403bs. Is there any way to get funds from a 403b into a Roth account?
Typically a Roth, just like a lot of 401ks have a Roth option, 403bs do as well. So anything we mentioned for the 401k is going to be the same for the 403b if the plan allows it. And that's the same for 401ks too. So we kind of use 401k and 403b interchangeably.
And then you can also, when you do your rollover, eventually from your 403b to a rollover IRA, you could then potentially start doing Roth conversions from that.
Very good. Okay, a number of questions about the new rule about moving 529 assets to Roth. Can you guys talk more about that? There's lots of questions around it.
I can. I actually just answered a few questions over the last couple of weeks about these. So in general, the questions that I specifically answered were whether you could do a distribution now from a 529 and have it count towards a 2023 contribution. And the answer that we found is yes, because even though the law is effective 1/1/24, in taking distributions from a 529 plan that's been in place for 15 years, I think that's one of the thresholds, is it has to have been in existence for 15 years. As long as you make that distribution before April 15th of 2024, you can designate it as a 2023 Roth contribution. If you haven't made any others, you can still do it.
And just to be specific there, it's a Roth contribution, not a Roth conversion.
Correct.
Which means they also have to have the earned income.
Yes. Yep. They have to have all those other requirements.
So speaking of the earned income, are there the high earner income thresholds for that 529 Roth contribution rule?
No.
Okay.
Let me fact check that.
Okay. All right, let's get to a couple more. Okay, so there were another set of questions around existing traditional IRAs and the RMDs that come from them. Talk about converting that to Roth if possible.
No, you must take your RMD. You cannot convert it to a Roth. You have to take your RMD first, pay income tax on it, and then you can continue to make Roth conversions from that same IRA.
So it's sort of no, but yes.
Yes, you must take your RMD and use it. But yes, you can continue to make Roth conversions regardless once the RMD rules have been satisfied.
Okay, perfect. So Robert asked a really great question around the sunsetting tax law in 2026. Are there any special considerations that they should be thinking about for Roth when it comes to this?
That's a tough one. I think it.
Can you repeat the question?
So Robert asked a question about the sunsetting tax law. I assume that he's talking about the higher exemption levels. So he's asking just does it apply in any way to this topic?
I think one way it applies is, you know, the idea that the tax rates may become higher. And so perhaps if you're thinking of converting, you may want to do it this year or next year before the tax rates go up again. That's one of those that's very hard to answer because no one's really sure exactly what's going to happen. But, you know, I think people would argue we are in pretty historically low tax rates, so it wouldn't be surprising that they're going to be higher later.
Mm-hmm. Gotcha. Okay, so I did hear you guys talk about the 5-year clock reset. Can you repeat it and go into a little bit more depth because there were a number of questions on that?
The 5-year clock on Roth contributions. So just there's a couple of rules as it relates to the 5 years. So once you make open up your first Roth account and make that first Roth IRA contribution, you have started the 5-year clock. So then you have to wait that 5-year period in order to be able to take out any of the earnings tax-free. Roth conversions have a similar 5-year period. Roth conversions, though, you have a new 5-year period that starts with every conversion. So if I convert this year, I start the clock on that conversion. If I convert next year, I have a new 5-year clock on that conversion. Any other thoughts on that, Kirsten, Ellen, that you wanted to clarify?
No, hopefully we don't need to worry about the 5-year clock because the idea is that we don't want to have to take it out.
That's a great point because we want to advise our clients to save that to pass on to their kids. The last asset you really, in general, it's the last asset you want to hit.
Oh, okay. That's a good point, Ellen. So can you talk to us about when you're entering into the retirement phase and you're starting to draw on assets, what's the order of assets that you should tap into typically?
I think we talked about this a little bit, but in general, when I'm working with wealth advisors, we're basically trying to manage the income tax rate. So normally what we're doing is some sort of blend between a regular IRA or taxable pension and using your after-tax assets. Because we're really trying to keep the income tax rate fairly normalized. And then dead last is the Roth IRA because that's the best asset to pass on to your kids. That's what I'm doing. Do you ladies have any ideas when you would change that around?
I think it would just be facts and circumstances for everybody are going to be different, right? So some people may draw from their taxable IRA, some and Roth, others depending upon what cash needs they have and trying to manage those brackets. But yeah, for the most part, I agree with you, Ellen. Hey, Christina, can I jump back in on that 529?
Mm-hmm. Yeah.
There are no the income thresholds don't apply.
Oh, thank you.
And it's 35,000 lifetime rollover, which means you're not going to be able to do it all at once because you're subject to the $7,000 limitation on a Roth contribution. So it could take you 6 years to get to that lifetime max of 35.
So you're saying if an adult has $100,000 in a 529 plan that they're not going to use anymore, they can only max convert 35,000
per beneficiary. Yes.
Per beneficiary.
Yeah.
Usually we're talking to the clients about, does it make sense to move to the next generation?
Right. There's options to peel it out to other beneficiaries as well. But this is honestly a great way to kickstart a retirement plan for a college student, right?
Mhm. Yep.
Pretty cool feature.
Yeah, awesome. Okay, so Pat asked a really great question. We're talking about Roths. They seem so amazing. It's tempting to just do all of our contributions to a Roth. Is there like a rule of thumb for how much you should put to a Roth versus pre-tax assets?
I wouldn't say there's a rule of thumb, but like Ellen said, what we're looking to do in retirement is kind of pull the tax triggers so that we control the taxes. So in that sense, you do want some taxable income in retirement. Otherwise, you're giving away free tax brackets. So we want a mixture. And again, a lot of other things play into how much, because it plays into how much you convert or whether you contribute to a Roth 401k or a traditional 401k pre-tax. But we wouldn't say it's an all or nothing thing, again, because we want to control and we can control the taxes in retirement by having some of that taxable money available.
Great answer. All right, Carolyn asked a question about, is there a minimum amount that is necessary to even open a Roth IRA?
$1?
Well, it depends on the custodian. Some of them require $10 to open. So basically, no.
Okay, perfect.
Yeah.
Okay, so when doing this Roth tax planning, who is the best person for people on this webinar to contact? Would it be their CPA, their wealth advisor? Who should they be talking to?
One,
I would say certainly both. Because it's a financial and a tax strategy. So certainly want to make sure that everyone is connected and on the same page and understands what the plan is.
And Kirsten, correct me if I'm wrong, but what I see happen a lot is that the wealth advisor does some of the projection and gets the ideas rolling, and then they pass the information along to the tax professional to solidify the information.
Right. We want to make sure we're working together because again, it's about coming up with a strategy first and foremost, but then also making sure the reporting gets done correctly, making sure that CPA, the tax preparers kept in the loop so that they know and don't misreport it because they didn't understand the circumstances. So it's really the advisor's job to be able to see the full picture because we're the ones who can see the cash flow 30 years down the road and understand when it may make sense to do. But once you've identified those, it's then bringing in the tax professional to make sure it all gets executed and reported correctly.
Perfect. There's so many great questions. Okay, another inherited IRA question for you, Jody or Ellen. Can an inherited IRA be converted to a Roth IRA?
No. Unfortunately, if it is an inherited traditional IRA, it is not eligible for conversion to a Roth. It is what it is.
Gotcha. Okay. Okay. All right. So I know that you've already talked about this, but there was a question, so let's just repeat it. Can you contribute the max to both a traditional 401k and a Roth IRA?
Well, so that question, yes, you can. And we didn't really discuss that. Within a 401k or 403b, you can only do the max to that account. But you can absolutely, in addition to that, contribute to an IRA on your own. Absolutely.
And that can be a Roth if you meet those requirements.
Okay, perfect. Okay, so back to the mega backdoor Roth. Do you need to take into consideration the pro-rata rule with that?
No, because it's done all within the plan, and 401ks never play into the pro rata rule. So it's being converted within the plan. It's still in that 401k or 403 bubble. So it doesn't have any impact or doesn't get any have any impact based on the pro rata rule.
Okay, perfect. So really popular topic about the children's IRA. There's a question about, to clarify, if the child does not have income, even if they're in college and don't have a job, can they contribute to a Roth IRA?
Not if they don't have earned income.
Thank you.
You need to get a dog walking job.
This, I heard the question asked once, well, what if the baby is an actor and baby receives, income from acting?
Yeah.
That works?
Yeah.
Yes.
Yeah.
There's no age
for baby.
Yeah.
Okay. I see some thank yous. This is very informative. How is modified adjusted gross income affected by Roth versus traditional IRA withdrawals? Maybe it's contributions.
It's just
sorry.
well, a Roth or a distribution from an IRA shows up on a tax return the same as a conversion does. So it's the same taxable income, goes into the modified AGI the same.
Gotcha. Okay. Thank you for indulging some of these repeat questions.
No, it's good. I mean, it's good to hear it on repeat.
Yep.
Yeah, and we know what's, most important to people. Okay, this question has been asked a number of times again too, so let's just tackle it one more time. Even if someone is in retirement, let's say over the age of 59 and a half, over 70, does it still possibly make sense to do Roth conversions?
Yeah.
Good, for sure. Depends upon why you're doing them. I mean, particularly if you're, as both Kirsten and Ellen touched on, if you're looking to do it as a legacy estate planning strategy, it could make sense. And that's why we always put a lot of caution tape up when people are talking about doing Roth conversions, because our advisors, we spend so much doing planning strategy about how much to convert, the timing of conversion, what are the tax dollars needed. We really want to make sure that, one, you're hitting your goals, and two, that you're not shooting yourself in the foot. Just because someone said Roth conversions, you need to do Roth conversions, that we're really thinking through what the goals are.
Right. You're all making it seem pretty easy to understand up here, but I've seen the work that you do behind the scenes, and there's a lot of work that goes into the projections that you guys are doing.
Multiple scenarios and multi-year scenarios. It gets pretty extensive in some cases.
Multiple softwares, multiple spreadsheets.
Oh, well, and we're looking at too, I mean, throw Social Security in there. Does the conversion depend on when someone wants to take Social Security and vice versa? And what impact does one have on the other? That kind of goes back to, where do you pull the levers as far as taxes? It depends on what you have in which buckets when you take Social Security. So there are 100 different things we look at.
Mm-hmm. Okay, Jody, I know you talked about spousal IRAs, but I like the way that this person phrased this one. Can a housemaker open a Roth IRA?
Well, if this housemaker is married and has a spouse who has earned income, then yes, that she can make a contribution using the spouse's income to do that. If the homemaker doesn't have any earned income herself, she can rely on the spouse.
That's where we see, I think, a lot of the backdoor Roth contributions, because maybe you have one spouse that hasn't worked or still has the 401k where they used to work, but maybe they don't work now, but their spouse does work. That's a beautiful time where they have no other IRAs to ruin the pro-rata rule, and they can just do that contribution every year. So
that's a great point. That's a great planning point. I see that done a lot too.
Okay, we have time for one or two more questions. Holly asked a really great question. This is regarding legacy planning. Does it make sense to do Roth conversions in retirement if you are not planning to leave it to heirs?
Not likely. We would still look at it because, yeah, there could be a reason, and it may not be that you'd want to do a Roth conversion, but maybe you want to take distributions to take some of that money early and lower tax brackets, but maybe it wouldn't be a conversion.
Yeah, I mean, they might have some wild situation where they have almost no income in that year and they've got a small Roth, or they could convert a small amount. But in most instances, it may not make sense. But like Kirsten said, we would thoroughly vet any kind of opportunity like that.
Okay, perfect. We only have 2 minutes left, so I'm just going to start wrapping this up with our final question. What resources or tools do you recommend for individuals interested in learning more about Roth tax planning?
I mean, I say, go to your advisor. If you haven't had this conversation, start having the conversation. And, it's really about understanding what your goals are with this money and how important it is to not pay IRMA or not to care to pay IRMA. There's a lot of discussions. And so starting that dialogue with your advisor is important.
Gotcha. Perfect. And that's a great cue for the point I wanted to make to close up, was to be on the lookout for an email that we will send you after this webinar. It will contain an article with more information on this topic that's really helpful. It will also have a link to a podcast that Jody recently recorded on this topic, as well as a replay to this webinar. So watch out for that email with the links that will come to you afterwards so you can read up on more. I'm going to share my screen quickly for the disclosures. And any final words from you tax expert ladies?
Don't try this at home. Get professional help.
But I would also say, if you have the opportunity to make a direct contribution for yourself or gift for a loved one who meets all the requirements, I would certainly be a proponent of doing that, and also taking advantage of any of the opportunities to convert or do backdoor Roths. There are ways to get money into Roths.
Ellen, any parting words from you?
No, I'm totally with Jody. Take advantage of all the opportunities that you're offered.
Okay, perfect. Well, thank you so much, panelists. If we didn't get to your question, someone from Mariner will be reaching out to you. We thank you all for your time. Thank you, panelists, for sharing your amazing wisdom with us. We hope you have a great day.